Good morning, everyone. Good evening, good night, wherever you're watching this transmission in this beautiful land of ours. I got an article here from Tyler Durden, our friends over at Zero Hedge, and yeah, it's a pretty big one. It's a big one to choose, so I want to kind of call attention to you guys on this one. Going down swinging, world's most bearish hedge fund loses 75% of its assets after the worst year on record. Well, I was actually okay. Let's read into it a bit, and I looked into this. I remember looking into this hedge fund. There's a lot to read here. I remember looking into this hedge fund. I don't know, like 13 years ago or 12 years ago, and it wasn't looking like this. I could tell you that right now. Where was it? 13 years ago. Where were we? Bring it back. Yeah, to just where 04, 05. It was actually 04, 05. It's been over 20. I mean, we're in 2020, guys. I can't believe where we're headed. It's like, anyways, every trader has heard the age-old saying, don't fight the Fed. Everyone, perhaps with one exception. Horseman Global's CIO and recently owner Russell Clark, who has been putting up his bearish bets in the face of relentless liquidity onslaughts by the Fed, ECB and PBOC, which now also includes the Fed's Note QE. Yeah, we've been talking about that here on this channel, right? And in fact, in his ambition to up the central banks, Clark may have overdone it because of, according to his latest investor letter, the fund's equity net shortened position is now the highest it has ever been in history, a whopping 110%, offset by 16.5% net long in bonds. Alas, while we admire Clark's courage, we have less empathy for the fund's performance, which has seen better days. And after slumping 6% in October and losing more than four of the past 5 months, is now on pace for its worst year on record, down 27.05 year to date, surpassing the 24.72% return posted in 2009, and reversing all the goodwill the fund created with its 7.5% return last year, when most of its peers lost money alongside the S&P 500. So you remember when markets started to somewhat make a correction after 2017. So 2017 was good. 2018 started seeing some sort of a correction, and 2019 things have been stagnant, and you have a couple of flares here and there or a couple of tweets get sent out where things start to change and markets start to take a turn. In light of above, we have been fascinated for how long the Horseman can remain solvent as the Fed remains irrationally bullish and liquid. So now we're looking at this. Okay, we're getting into repo market discussion, right, guys? And we were talking about repo markets, and you know how I feel about repo markets, and I don't think, and I've said this already, they're not analyzing the assets being analyzed, so they're not assessing them properly, and they're giving freely capital to these assets that they don't know what the true intrinsic value of these assets are. I think they're just keeping companies from going under. That's it. So, and this injection every day, it's not good, because the banks need to create some sort of a balance sheet, right? And it's giving the banks or giving the corporate or giving these companies, giving them like more of a risk then, I guess, to take more chance, I guess, to gamble even further, right? And it's giving the banks a lot more flexibility on their credit sheets and balance sheets. I'm sorry. It's giving them more flexibility for that overnight rate. And that's how we're seeing the recent repo strain we're seeing now. So yeah, it's like robbing Peter to pay Peter. Well, you're not paying Paul back, but you're robbing Peter to, I wouldn't even know how to put that in metaphoric. Yeah. In light of the above, we have, okay, let's look at this here. So here it is, historical gross and net exposure. So there's the gross exposure, net exposure, and then you got, wow. There it is on the bad position, gross / short. Wow. Wow. That's getting it from 01. I think I was looking at around here, 04, 05. I was looking into this fund back in the day. Actually, I was. Yes, I was. Oops. Oh, I closed it. All right, let's get back to it. And here it is here. Ooh. 27.05. That's not good at all. All right. In light of the above, we have been fascinated how long Horseman can remain solvent as the Fed remains irrationally bullish and liquid. And unfortunately for Clark, who recently put his personal money where his mouth is and bought a controlling interest in Horseman, where he was a main portfolio manager for years, the answer appears to be not much longer. As the fund reports on October 31st, the AUM for the Horseman Global Fund is just down $150 million. There it is for the month. And there it is, Class A shares. There's the fund price. And there it is in US dollars. There it is in euros. And there's the Class B shares. Horseman Global Fund lot. There it is there. And there's the net performance there. And then there's the year to date. And there it is here in US and euros. And there it is here. Horseman Global Fund lot, US 581 million. So, what is the Hail Mary attempt? I love Zero Hedge. What is the Hail Mary attempt by the man who this past May told Bloomberg he is betting it all on the market crash? While it's not a new bet per se, Clark doubles down on his bet against the custodians of market stability, naming clearinghouses, and in his latest letter ties it to a growing liquidity problems revealed by the repo market chaos, to wit, cash hoarding and repo market problems could be a sign of counterparties beginning to worry about clearinghouses. Below, we present the main thrust of his October investor letter for those of who, if not to recreate his trade and at least follow what may well be Clark's last-ditch attempt at preventing his business and reputation. So here it is, if you guys want to read it. And let's see what he has to say here. There's a little bit. Hold on, let's get some audio here. Where's audio? I can't hear this. It's not giving us audio. It's not giving us audio. I kind of wanted to hear this actually from his lips here. Yeah, we're not. It's giving us audio, but I can't hear it. Yeah, damn it. No biggie. Just kind of wanted to throw that in there for you guys. Let me know what you guys think. This is a huge problem. When you start seeing things like this, when you start seeing hedge funds faltering like this, you start to see more bankers jumping off roofs of buildings, and you start to see more and more. It's right here. Fed remains irrationally bullish, and keeping it liquid is basically giving the banks more balance sheet flexibility is what it is. And it's causing these repo strains, and that's what I feel in my heart of hearts, and they're not looking at what they're funding, and I think they're over lending or overvaluing. They're not assessing the assets being analyzed, and I think this is the problem we're looking at here with this whole repo, and that's where you're seeing repo strains. So I don't know, guys. Let me know what you guys think in the comments below. Is he right? Is he wrong? This is a big piece to chew off here. I'm looking forward to reading your comments on your opinions on this. Let me know. Thanks for watching.